Namaskar and good morning to everyone. We are delighted to inform that Symbiosis Law School Noida with AZB and Partners has organized a webinar series titled Masterclass Corporate M&A Transactions. Second session of the masterclass is scheduled for today, and it will be delivered by the Master, Mr. Hardeep Sachdeva, Senior Partner, AZB and Partners. The session would be moderated by Mr. Rajneesh Jindal. I would request Mr. Rajneesh to explain the rules of housekeeping to the August gathering. Over to you, Mr. Rajneesh.
Thank you, sir. Thank you. On behalf of Symbiosis Law School Noida, I welcome you all to the second session of Masterclass on corporate M&A transactions. And regarding the rule of housekeeping, I just want to inform you that question and answer session will take place once the discussion is over. Participants will be asked to raise their hands and then will be asked to unmute and to switch on their videos. And after asking the question, you are supposed to turn off the camera and go to the mute mode. So without taking much of your time, I would like to hand over the reins of this masterclass once again to the master of this domain. So over to you, Hardeep, sir.
Good morning.
Good morning, sir.
Good morning, everyone, and thank you very much once again. Just give me a few seconds. I'm going to switch off. Sorry. Good morning. So last time we spoke about the corporate M&A transactions, or let's say the key corporate M&A transactions, which form the major part or major practice of corporate M&A lawyers, which are those three transactions that three categories that we spoke about: joint ventures or securities or share investment transactions, or the business transfer transactions. I mean, those three are let's say, the key buckets within which majority of the corporate M&A transaction will fall. Now, the second aspect that I wanted to take all you folks through is the financing transactions. And why financing transactions are important, or why financing is important, is I think what we need to understand first. I think it's sort of a no-brainer to say that every business requires financing or requires money for us to do the business here. And that money can be in the form of equity contribution, means that your personal contribution into the business, or that money can be in the form of a debt contribution, means the money that you have borrowed from someone else to do your business. Now, your money, which can be your equity, and money that you bring from someone else, which can be a debt money. Obviously, you can get equity also from someone else. I'm not touching upon that aspect here. We're only picking up the key components so that we can take you through the next level of this, this corporate M&A transactions part of it, which is the financing part of it. So when it comes to debt, it means that you have limitation on the equity and you need to borrow money from someone else to do what you were doing as part of your any of the corporate or M&A transaction. We categorize it into a financing transaction. Now, in a financing transaction, there are always some conventional, traditional financing which takes place, which are your traditional, bank loans, your term loans, or your traditional working capital loans. I will not be talking about those traditional loans or financing, which are still contributing a very high or a significant amount of money for these transactions, I will today pick up the other non-conventional or non-traditional means of financing which are relevant for these corporate M&A transactions. Now, those I had given 3 categories for those financing transactions. Rajnishi, I want to put something on the screen just to quickly. Can I share screen?
Sure, sir. Sure, sir.
Yes, sir.
Is it visible?
Yes, sir. It is visible, sir.
Okay, I just wanted to show everyone as to what's going on in the market presently. This is an article that came in Mint newspaper. It says bonds overtakes banks in funding for corporates. It is as late as 1st December 2020. So my first subject or the first topic in the financing transactions was the NCDs or the bond transactions. And I'll take you through what these bonds are. But what's happening in the market is that these bonds or these, we call them debentures or non-convertible debentures, they are today forming or contributing more than what traditional funding used to be there earlier. So today the bond market, I don't know how much of us understand a bond or a debenture. Maybe if I can go back to the basics, a debenture is a defined or a bond is a defined term under the Companies Act. It simply represents a debt due by the issuer company to the holder of that bond or the debenture. Now, a debenture or a bond is far more convenient way of seeking financing by these corporates or these companies in last over, if I can say 3 to 4, 5 years, because the takers of the bonds or the investors for these bonds have increased significantly. And these investors were not just the banks or the traditional lenders, the banks or the NBFCs. These investors for the bonds were also the the corporate houses, people like all of us who may want to invest into any company's bonds, the mutual funds, the foreign investors or foreign portfolio investors, and the list is very long. And then these bonds or these NCDs were not following a traditional banking of, there used to be 4 C's in traditional bankings earlier, where every bank used to evaluate a loan or a borrower, which 4 C's were the character, the collateral, the capital, and the capacity of any borrower or a promoter who was seeking a loan from a bank here. These bonds or the debentures in today's time, they were looking for liquidity, the return, the limited security, or the structured financing attached to that bond when the investment was made into these bonds here. So these bonds, I'll just take you through 6, 7 of these key components of these bonds here. The bonds or these debentures could be listed, could be unlisted. It means that I can have a bond issued by a company listed at any stock exchange in India or outside India. These bonds can be privately placed. These can be issued, let's say, in private discussions to any investor or a group of investors, or there can be a public issuance of these bonds. In the past, there happened several public issues of these bonds, some done by maybe some large financial companies only, and some done by other corporate houses, where they made a public offering of these bonds and issued them to the public at large, who was earning reasonable interest on these debentures or the bonds for the life of the bond there. It is all between the bondholder and the issuer as to how these bonds can be placed here, either public offering or a private offering. These bonds can be secured or unsecured. Now, the security is again between the issuer and the bondholder or a subscriber. The security, this is, I think, third in my list is talk about the securitization, which I will discuss in detail. But the security can be of your fixed assets or your receivables or a corporate guarantee or a pledges or a mortgages, which I'll take you through in the next round. Or these can be unsecured as well. These can be any bonds, any debentures where there is no security attached to it. These bonds can carry coupon rates, which can be your fixed coupon rates, fixed in terms of a monthly coupon rate or a quarterly coupon rate or a yearly coupon rate. Or these bonds, in lots of cases, you'll be surprised to note, are zero coupon rate but are carrying a redemption premium. Means that during the life of the bond, you will not be getting interest service to you, but at the end of that bond, or maybe during a periodicity which is part of the bond offering, could be at the middle of the bond term or the end of the bond term, the bond holder or a debenture holder will receive something called redemption premium. Means the bond will be redeemed in part or in full at a premium amount, which will show that the bondholder has made enough gains, which could be your internal rate of return, which could be your simple coupon rate calculated cumulatively till the date of your receipt of the redemption premium, or which could be linked to the profits made by the corporate or linked to the cash flows received by the corporate. Now, this was actually the second part of my, of the financing, of this whole thing, is that these can be structured in a way where you're not simply paying interest to the bondholders, you are paying them redemption premium, which can be linked to the profits made by the corporate. So the premium can go as high as an example, 30, 40, 50% of the profits made by the issuer company. These bonds are usually rated by the rating agencies. I'm sure people must have heard about a bond which is AAA, some bond is AA, some bond is for different rating here. These are rated by the rating agencies. There are few rating agencies which are there in the market, and usually you'll also find that there is a trustee attached to a bond. That trustee's job is to be a custodian holding the securities attached to the bond or doing some actions for the bondholders in the benefit of the bondholders. So trustee is a custodian, and it's not like anybody can become trustee. These trustees are SEBI registered trustees, or some companies which are registered with SEBI to act as trustee for the debenture holders or the bondholders, where they will be holding the securities for the benefit of the bondholders. And there are some 25, 30 companies which are allowed to do such a business here in India. So corporate bonds, corporate debentures is the new norm in the market, which is taking over from the conventional lending or the conventional means of financing in the market in India. As I showed you that article, there are 6-7 key elements attached to the bond issuances, which is it can be listed, unlisted, it can be secured, unsecured. It all depends, it all between the issuer and the taker. It can be privately placed, where one doesn't need to have the prospectus filed in large detailed form, or it can be a public offering of the bonds, where anybody from public can make application to get those bonds here. It can be interest bearing with the periodicity, means monthly, quarterly, biannually, or annual interest, or it can be a coupon based or a redemption premium based, where you will not receive anything during the life of the bond. You may only receive at the end or at the half of the life of the bond of something called the redemption premium, where the bond is redeemed by the issuer and you will receive your capital along with some returns back in your hand. It is usually rated, or in some cases it is the mandatory requirements of SEBI to rate the bonds by the rating agencies. And then last is it has a trustee, where the trustee is acting in the interest of the bondholders to hold the security package for the bondholders. And then people usually ask, why do we need trustee in these bond markets? So now it's very interesting that whenever you get a security created in favor of a bondholder, you will have to sign these security agreements, like a mortgage deed, like a hypothecation agreement, like a share pledge agreement, in the favor of a bond holder, which means that if there are 10 bondholders, I will have to sign these agreements with those 10 people. And just imagine if these bonds are listed on the market, then every time there is a change of the bondholder from person A to person B, these security agreements would have required amendment to incorporate the name of the new owner of the bond. But to ease this whole flow of a transfer of bonds, while without having any requirement to amend any of those issuing agreements, the whole trusteeship was devised. So trustee is the one in whose name a security is created. Trustee will be holding the security for the benefit of any bondholder who may be holding the bond from the beginning till the end. Means that if I'm holding the bond today, the security held by the trustee will be held in my benefit. If I sell these bonds to somebody else at a later date, then the same security will continue to be held by the same trustee for the benefit of that incoming investor who will be owning the bond here. So this trustee is that beautiful structure where there was no need to keep amending yourself, keep adding, subtracting names of the bondholders from the security documents per se, while you are having the same security continuing between the transferee share, the bondholders, till the bond is redeemed. I mean, once the bond is redeemed here, once the money is paid back to the bondholders, there is no need for that security, and therefore there's no need for the trustee here. But till that time, the trustee was always there to hold the securities for the benefit of the bondholders. Now I'll just quickly come to the structured financing. Now, as the name suggests, when we first spoke about the conventional financing, which is your bank loans, which are your typical term loans given by the banks, or the capital or the working capital loans. In that conventional bank loans, the if I can just strictly say that the role of a lawyer is very limited because they follow their own standard set of agreements and documents, and they sign and disburse the loan here. They do their own, as I told you, conventional 4C due diligences, which is the character, the collateral, the capacity for the borrower to get the loan from a bank here. Then we move to the bond markets. What are these bond markets? Bonds are debentures or bonds. The name itself can be a bond issued by corporates. It can also be issued by the government, but I'm not talking about the government bonds here or the GSEC bonds. We're just speaking about the corporate bonds here, which are issued by the corporates to seek financing from the investors. It can be from any lender as well, can be from any bank as well, but largely from investors community where they invest into these bonds. Now, if I take a step back and then can still explain why will somebody invest into a bond and not equity share? It may be that all of you may know, but I'll still say that when you invest into equity security, I mean, all the bonds and the debentures and the shares are called securities of the company. When you invest into the equity shares, they are high risk. There is no guarantee that you will get paid or you will have any security from the company. The equity capital can get you only a dividend. Dividend can be declared when the company has made profits, and then equity can be returned only when the company has the profits and the reserves, and the company follows certain guidelines for buyback of shares or for reduction of share capital of the company here, which is the investment into the equity securities of the company. The bond market or the bonds or the debentures, these are the debt of the company, which is that even if the company is not making any profits, for so long as they have the money to pay, they will have to pay to the bondholders, which are nothing but their lenders. These bonds can be secured. It means that they have to pay money to the secured lenders. They are nothing but the secured lenders, which also means that if the company fails to pay to the bondholders have the right to seek recourse to the company or recourse to the security. Now, what that recourse could be, let's say if a bondholder if is not paid its due interest, and if that interest amount is above a threshold which is which is prescribed under the insolvency and bankruptcy code, then the bondholders can take the company into liquidation at NCLT and seek liquidation of the company or seek the resolution of that insolvency of the company. It means the company is not solvent to pay its creditors or its bondholders beyond an amount here. The bondholders can also, under the SARFAESI and other statutes, it depends, if you got a listed bond, then the trustee has all the powers under SARFAESI. The bondholders can also take foreclosure of the securities given to the bondholders to recover their money. Now, you don't have the same luxury there, if I can call it a luxury, with the equity shareholders. The shareholders, in that sense, will have to sit tight until the company has made profits and declared dividend. They will not receive anything from the company. Until the company has profits and reserves, they will not even get a share capital back from the company. Whereas the bondholders or the debenture holders are akin to a secured or unsecured lenders, where even if the company doesn't make any profits or the company cannot distribute money or before they make any distribution to anybody else, the company is bound to pay to these bondholders. Then these bondholders have the powers to take company for liquidation or to seek foreclosure of any securities issued to these bondholders for recovery of their money. Now, bondholders are, in that sense, if you compare with equity, their risk is far lesser than equity shareholder. So equity shareholder has a far higher risk in the company because they can lose their equity value. But the bondholders are like lenders. They have the lesser risk in the company as compared to the equity shareholder. But barring the structured financing, which I will just tell you, where one can still have the distribution of profits given to the debenture holders, barring that exception, the return that a bondholder makes is limited, whereas the return a shareholder can make is unlimited. Let's say a company makes phenomenal profit, a huge profit, which is far more than its outstanding debt, which is far more than the amount required to service interest. It need not to pay to the bondholders beyond what was agreed to be paid to them, which means that if a bond is issued at a 7, 8, 9, 10% per annum sort of an interest rate, then the company is still bound to pay them only their bond amount back along with that interest. And all remaining profits of the company will only go to the equity shareholders. So the returns are high because the risks are high as far as equity shares are concerned. Returns are limited to an agreed amount, and therefore the risk is lesser for the bondholders. Just to explain to you, as to how the bonds are placed between the equity and the equity and other shareholders' risk there. And again, when it comes to any liquidation of the company, especially if it is insolvency, the secured creditors, so the secured bondholders, comes first in the list. They are far above even the employee payouts and the statutory payouts, first in the list to get paid because they are the secured creditors. Then, of course, secured, unsecured, the government, the secured, unsecured over the last 1 year, the human resource payouts and the government statutory dues, the whole list is there in the IBC. Now that's about the let's say the traditional banking or the NCDs or the bonds. And third, very interesting thing, which is usually part and parcel of any corporate M&A transaction, is the structured financing. Now, usually a question is asked, what is the difference between the normal financing and the structured financing? Now, structured financing is not a defined term anywhere. So it's not a definition where one can find what is a structured financing and what is not a structured financing. Therefore, our bonds issuance and our NCD issuance can also be part of our structured financing. But structured financing, as a thumb rule for corporate M&A lawyers, is that complex and not traditional or conventional, a very complex financing of a business or a venture or a company. Now, when let's say when we need to raise money to buy shares, Now, traditionally, banks in India are not allowed to lend money to anybody to buy shares. So when you have to raise money to buy shares, you need to structure your financing. It can be as simple as this. If I want to buy shares of a company and I have a limited capital, and as I spoke about, when you do M&A financing, you'll borrow money to buy the company. How can you borrow money when the Indian banks are not even allowed to lend money to anybody to buy shares? This is where the role of structured financing or a financing with structures come into play. So I still call it a vanilla structured financing because it is still the beginning of what the structured financing could be. And the other examples of structured financing, which I'm sure most of you may have heard of, is your mortgage-backed securities. When the securities are issued with the backing of a mortgage given to them of a portfolio of a loan, or your collateralized bond obligations, your CBOs, or your collateralized debt obligations, your CDOs. I mean, these are the very fancy terms which are, or synthetic loans, or these credit default swaps, or any hybrid securities. These could be various examples of structuring of financing for a business. So I picked up one where we speak about structuring financing of any buying of shares. One could be, let's say, if I have to securitize my one loan portfolio. Let's say if I'm a lending company, I have a loan portfolios of maybe 100 loans. If I just pick up the 10 loans and I want these to be sold in the market, I can have a structured bond where I can have the collateral given only of the amounts receivables from these 10 loan portfolios. I can have that bond issued to investor as part of my structured financing here, which means that the investor who will be holding my bond, where I am the becoming the borrower for that investor, he will have no recourse on me. He will have recourse only on these loan portfolios which I'm trying to sell to him. And these structures are usually follow to get the financing into the system to, let's say, monetize any of your asset when you're doing any M&A deal, or when you're doing any corporate deal there. And a corporate deal will also include a deal when you are selling the loan portfolios, because even the loan portfolios are nothing but part and parcel of any corporate M&A. You buy and sell loan portfolios all the time. So what we do is that we create a structure where we house these loan portfolios underneath a trust. Trust issues a security. Security means a bond or a unit, we call it depository receipt, to the investor, who will not become the lender by itself to the underlying borrowers, but will be getting the entitlements or the money whenever those ultimate borrowers have given money back to the trust, who will give it back to the depository receipt holders, or a receipt holders, or a unit holder, who will be holding units only for the purposes of buying the loan portfolio. And these are called the collateralized, bond issuance, or collateralized debt obligations. Now, structured financings can be tailored, in various ways. So, if I come back and just speak about, things like, maybe it's all publicly available, in from knowledge and all part of the case laws. So I thought of just touching upon case like, ArcelorMittal buying out SR Steel in the NCLT, and we all know that they bought the entire company for some 42,000 crore rupees. But then, did they pay equity to buy this company here? Did they contribute the entire amount as equity into the company to buy the company out? They did not do that. What did they do is that they had replaced the existing lenders of this company getting into liquidation, which is SR Steel, with the new lenders that they have brought with them to buy the company out. And that has been the case in most of uh, the the bid process, or the resolution of these insolvent companies, or company under insolvencies that's happening there, where the incoming bidder or the buyer is not bringing in the money to buy the shares of the company. It is only bringing in the lenders to replace the existing lenders of the company. So the structure is such that I still buy the company, but I'll pay X rupees or a limited amount of money to buy the shares of the company. Remaining amount that is required to buy the company out is getting financed in such a manner where I'm only paying out the existing liabilities of the company. So when we look at a company here, when we look at any target buy, we always look at the target's existing liabilities that can be discharged through a loan that can be availed for this buyout. Because as I told you that a simpliciter loan from a bank in India is not possible to just simply buy the shares, because the Indian regulator classify it as a speculative loans. They frown upon these such financing to buy shares. So the way it structures is you just put the enough money to buy the shares, get the debt to discharge the liabilities to the extent you can, and that debt can be again in the form of a bond issuance to be made by this company to investors, and these investors again can be your domestic Indian investors, your mutual fund houses, your corporate houses, your HNIs, or the biggest investor which is there in India for these bonds is the foreign portfolio investors. So when we speak about FDI in India, this FDI usually is is sort of a subset of a term called foreign investments in India. The first term is the foreign investment in India, which has the foreign direct investment, where they largely classify your equity instruments or the convertible instruments, which are compulsorily convertible into equity instruments, which is your FDI part of it. The remaining part of foreign investments in India comes through these FPIs or large multilateral financial institutions through debt in India. And this debt comes in the form of bond markets or sometimes comes in the form of the external commercial borrowings. Now, end of the day, we still have a dearth of financing or the dearth of capital in India, and therefore most amount of our investments are funded by the foreign investments, where the money comes from the foreign portfolio investors, which money comes in the form of the bond subscription or the bond buyout by these foreign portfolio investors. Now, there are more of these new age fundings, which I think which phrase we have heard only very recently, which is yet to make its dent in a larger sense. It may be making its dent in terms of the number of people participating, but yet to make a dent in terms of the quantum of the money flow into the economy, which are these new age crowdfunding, your P2P funding, which is your peer-to-peer funding, your microfinancing, and then we heard about these, your small bank financing. There's a new phrase which is making buzz in US markets is called SPAC funding, where there is a special purpose acquisition companies are set up akin to a blank check company, where investors are investing money without knowing as to how will this SPAC will eventually use this money. These are called blank check companies, which is a very US centric term and US centric sort of a financing model, where money is contributed into a vehicle, or they call it SPAC, special purpose acquisition company, and the trustees or the managers of that vehicle are using this money by simply giving let's say one liner objective as to how this money will be used, but without disclosing the details of the target where the money will be used here. I mean, these are all new age lending, where, as I said, that either a peer-to-peer financing or a crowdfunding. I mean, these are again picking sort of a momentum in the number of people getting involved, but not yet has made any impact on the quantum of financing which is required by the Indian corporates. So as I first showed you one slide here, the quantum of financing is still between the conventional lending, which is by the banks, by the non-banking financial companies, or now by the, or it is still, let's say, a split between the banks, or now by the bond issuance, where the bonds are issued by the Indian corporates to various investors, to public offering, or to anywhere else to fulfill their need for a financing that they have for any of their activities here. I mean, I will not get into too much details about the structured financing, because every structured financing is by itself sort of I think class we need to do, because I don't know how many of you remember historically we seen the fall of Lehman Brothers in 2008. If you people remember the phrase used at that point in time as to what led to the fall of Lehman Brothers, and therefore the entire stock market in USA and therefore all over the world, was something called CDS, or the MBOs, which are the credit default swaps, where the word itself suggests that there are these not so good loan portfolios who were bunched into or pooled into a separate, let's say, structure, where the securities were issued of those CDS to investors, knowing fully well that these underlying securities of these bonds are going to default one day, but they still traded very well when they were issued in the US stock market, and eventually led to a complete bust, because the strength or the capacity of those underlying loan portfolios was anyway into default at the very beginning. So as I spoke at the beginning, it could be your CBOs, or collateralized bond obligations, or a collateralized debt obligations, where, so if I have a loan portfolio, I can always say that these 10 are the high risk loan portfolios, where I know that they may or may not pay me the money, or their quality of security is eroded in last 2-3 years because of the market factors or because of their own performance. But I still sell the loan portfolio through a structure of a bond. Then the subscriber of the bond knows on the day one that this bond can fail. But if they turn a blind eye and then keep trading in the bond in the listed market, because this bond can be listed by that time in the market, they can be sold to different fund houses. Then one day, what will happen is what you knew it will happen, which is that these bonds will default only. And this is what happened largely for the Lehman Brothers, or the fall of stock market at that point in time, where everybody knew that they are trading, or they are highly trading in the poor quality paper, knowing fully well that one day it will default. But when it defaulted, by that time they were so much into holding onto that paper that they had no choice but to declare themselves bankrupt. So, this is history, and we can one day maybe pick up some of these structured financing as to what happened in detail, especially at the Lehman time, because it was all a result of a very aggressive, high risk structured financing bonds which were issued and which went bust. And therefore, when I spoke about the bonds and the debenture markets in India, these are still maybe risk bearing, but they are far more better quality paper that way. And therefore, there is a rating done by rating agencies. Why am I saying better quality? Because they are not usually backed by, or usually a creation of a pool of investors or the loan portfolios. They are usually issued by the corporate houses, where you know who is the issuer, where you know and assess the financials or the strength of that issuer at the time of subscription of these bonds there. Then I'll come to my third subset of this the financing transactions, which is the securitization. Now, I will not touch upon the securitization the way it was done, let's say, for the structured financing part of it, where anything can be securitized to create or package a bond and can be sold to the sold in the market. We are not on that. I will just pick up the traditional securities which are usually created for any loans or any bonds or the non-convertible debentures. So when I showed you that first clipping here, when I spoke about the traditional financing in India, when I spoke about the NCDs or bond markets in India, I spoke about with the security in mind. So if you remember, I spoke about listed, unlisted, secured, unsecured. When I speak about secured, that security in India is usually covers three key things. First is the security over the fixed assets of the issuer. And the fixed assets means land, building, factory, those immovable properties, the fixed assets of the company or the borrower or of the person giving the collateral or the person giving a sort of a security on behalf of this company. First is the security over the fixed assets, which is usually created through a mortgage. A mortgage is created over a land or a building. This mortgage can, again, I'm sure you would have read by now that this mortgage can be your equitable mortgage or a registered mortgage or English mortgage. It all depends how do you create a mortgage here. But the first and the foremost security that people look for in these loans or the bonds or the debentures is the security over the fixed assets of the issuer or a collateral who's giving a collateral there. Second is security over the current assets or the movable assets. So first is fixed, immovable. Second is the immovable. Now this immovable can be the pledges on the shares of the company, which is taking the loan, so that those shares can be pledged to the lender, to the bondholder. In the case of bondholder, through a trustee who will be holding these pledges of shares. It can be hypothecations of the amounts which may be received by the borrower in his business usual. So let's say if there is a road concession company which is getting into the setting up of a toll road, then all the toll collected in future by that company can be securitized through hypothecation of those receivables in favor of the lender, which means that all that money which is to be received by the company in future today is getting charged in favor of the lender. And to implement this charge, you open an escrow account and make sure that all the money is collected and received by this toll collector company borrower of yours into that escrow account where you have the charge on the money. It means that the lender can take the money out to service its interest and to pay its scheduled repayment, the redemption of debenture or a scheduled repayment of a loan, whatever is due at any time. Another example of movable could be your stock in trade, which is again can be charged in favor of the lender. Other could be your IPRs, your trademarks, which can be lent, charged in favor of the lender there in the bucket of securitizing the movable assets of the borrower or the person giving the collateral. There could be any other movable assets that can be available by any borrower, but these are the large 4 or 5 categories in which these can be, or these usually find its place, which is again your stock in trade, your amounts which are receivable by you, your pledges of shares, your IPRs which can be lent or charged in favor of the lender. Third key security given in any loan in India is, which is not very prevalent in the Western countries, but it's very prevalent in India, is the corporate guarantees or the personal guarantees of the promoters. So if the promoter company is the holding company of the borrower, then that parent company gives corporate guarantee as part of the security package in any loan, in any bond issuance. Or a person who is the promoter of that borrower or the issuer, he gives or she gives the personal guarantee for the loan which is obtained or to be obtained by the borrower, or for the issuance made by any company of any bonds or any debentures. These three are key buckets of security for any of the lendings that happens in India. I mean, if we just do not talk about the structured financing, where the securitization can be of that particular structure, of that particular, let's say, part of the business or part of the asset of a company here. Otherwise, largely everything will fall in these three categories for any securitization of any loans in India. If it is a bond issuance, as I touched upon, all the securities will be issued in the name of the trustee. Means the trustee will be the holder of securities, means the mortgage will be registered in the name of the trustee. The share pledges will be done in the name of the trustee here, which trustee usually have their own demat account if there's a demat, or if the shares are in the demat form, where the shares move from the name of the shareholder who is pledging these shares to the escrow accounts of the trustees, where these can be foreclosed at any point in time whenever there is a default or whenever there are agreed terms of foreclosure of these securities. If these are not done for the bond issuance or for the debentures, traditionally these securities are also placed in directly in the name of the lender as well, where one bank, one lender will get this security registered in its name and can lend the money against that security is offered to the lender here. Now again, there could be various other lendings in the market here. I mean, I'm not talking about, let's say, the personal lending or the friendly lending or the intercorporate borrowings, intercorporate deposits. Those are all are the subset of either conventional lending or the bond market, or they can be different sort of a module as well, which could be still very small in the segment, which will not have a big impact as what we are talking today here. Because if you look at the impact, or if you look at the funding or financing happening in the economy today, it is either traditional bank funds, and when I say bank funds, I'll include banking and the non-banking financial companies, or the bond markets. These two are making their inroad in terms of super majority of the financing that's happening in the country here. If it is a bond, could be listed, unlisted. I mean, there are several of these bonds today listed in the market here, which most of us sometimes take to earn a little higher rate of interest. But historically, there have been big corporates who have defaulted to the depositor of to their depositors when they make default. But that is far more streamlined in terms of the bond market, where the regulations are more stringent, where they have a trustee in place always to make sure that the rights of bondholders are properly secured and enforced through the proper course of law. And therefore, this market is maturing in India as well in that sense. And of course, I'm sure we all know that some sectors are far more capital intensive than others. Therefore, the need for money in those sectors is far higher. So as an example, the sectors which are your steel, rails, airlines, oil and gas, they require far more capital than some other sectors which could be FMCG manufacturing, or maybe liquor bottling or other manufacturing sectors, where you could require lesser sort of financing there. Again, there are various other financings in the market which can fall in the bucket of traditional financing. If I can still touch upon things like your lease rental discounting. So one of the biggest exposure that the banks in India have is towards the lending on the fully constructed and leased real estate assets. So in that sort of asset, the rentals which are promised or which are coming in that asset. So let's say if there is a big building which is fully leased to some corporates, and the owner of that building is receiving rents on a monthly basis from that leasing, these rents or these receivables can be discounted for the owner of that building to get the loan from a bank, where the bank will assess the receivables that will come on a monthly basis from the leasing of this asset and will discount it to the extent of maybe 100 times of a monthly rental, and then give that money to the owner of the asset as one of the structured financing, where it is a structured financing, but it's not that complicated because it is far more known and implementable and implemented financing by Indian banks here, where they usually do not lend to the companies to buy land. They can lend only for the construction, or they lend money for the lease rental discounting of a company here. Now they also can be said to be structured. I mean, we did not touch more upon these, but these are specialized lendings that happens, but they are either falling within the bucket of conventional lending of the banks, or sometimes the lease discounting can also be done through the bond issuance, where bonds are issued and where you share, where you service these bonds from the monthly rentals or quarterly rentals that the issuer of the bond receive. Now there are more ways of financing which we did not touch upon, like any of these REITs where real estate investment trust are the units are listed, or in infrastructure trust units are listed, where the financing is raised, where again the unit holder of these trusts receive money on a periodic basis. I mean, it's not a debt due in that sense, but they receive money on a periodic basis as investment into the capital asset, or akin to a capital asset, because they themselves don't own it, but yes, they have the right to participate in the periodic returns of those assets there. I think with that, obviously we can, this is such a area where we can keep speaking until I love the phrase, until the cow comes home. But yeah, we are happy to take any questions and see how we can get more clarity of any issues that you people have in your mind on these financing transactions part of it.
Yeah.
Rajni,
yeah. Thank you very much, sir. Thank you for dealing with these financial jargons, because for a person who is basically from this legal domain, so it becomes very relevant for them to understand these financial jargons, and so these kind of little intricacies which you have dealt in a very wonderful manner. So now I would like to request all of the participants to please raise your hands and please ask your question. And while you ask your question, please switch on your videos, and please after mentioning your question, you please put yourself on the mute mode as well as keep your video off. Thank you very much. So I would like to ask Prishita to please unmute yourself and switch on your camera and ask your question. Prishita.
Good afternoon, sir. Thank you, Rajni sir. Thank you, Ravande sir, for giving us this opportunity, and thank you, Hardeep sir, for such a refreshing session. My name is Prishita Chadda, and I'm a fourth-year learner. Sir, we understand that there are varied forms of financing that can be employed to undertake a merger or acquisition transaction. However, keeping in mind that the market dynamics have changed tremendously due to the COVID-19 pandemic, my question to you is, what can be considered as the best form of financing for M&A transactions, keeping in mind the said pandemic? Also, sir, would the newer, more hybrid forms, as you mentioned during your lecture, take over the traditional forms of financing while we're looking ahead?
Thank you. Of course, it's a very good question, and I must tell you that as I touched upon the transformation from the conventional lending to the bond issuance has happened in India. In the Western market or in the Western world, the transformation from the conventional lending to the bond market to the hybrid instruments have already taken place. So yes, when these markets are matured, you will find that hybrid instruments will be the flavor of the season in time to come. And hybrid instruments are where you will be owning a debt instrument with the with the returns of equity instrument, as an example. So if you remember, I touched upon a bond where the bond holder will not be getting interest or a fixed coupon, but the bond holder will be getting some redemption premium from the issuer based on the performance made or the profits made by the issuer. These are called the hybrid instruments here, which has already taken place hugely in the Western world, in US or the European markets here, or the Japanese market or the Chinese markets also, but not yet in India. But yes, this will come very soon. Now coming back to the COVID time, obviously for first 3-4 months, so barring one company which has really brought I think 1/3 or half of India's total FDI. Barring that, not much M&A happened in India. I can tell you in the month of April, May, June at least. I mean, except for let's say Geo platform, which has raised, we all know, billions of dollars, or then Reliance Retail, when platform raised another few billions of dollars. Barring that, deals happened on a very small pockets. And when the deals happen in the small pockets during this COVID time, or during these challenging times, at any point in time, the deals happen based on the equity of the investors, because the financing or the financiers, they don't take risk during this time, or they don't take any extra risk during this time here. And in terms of M&A financing that has happened, those happen in the form of, to the extent money is required to buy equity, people have bought equity. To the extent they can infuse same money from the same investor into the company to discharge liabilities, same money from same investors came in the form of loan. So let's say if I have to buy out a company where the equity value is in 20 rupees and the company has liabilities of 80 rupees, means I have to pay 100 rupees to buy the company. I can put 100 rupees into the company, pay the liabilities as equity, and I use 20 to buy my shares. Instead of doing it, what people have done is they have used their 20 to buy equity and used 80, which could have been equity, given as debt to their own company, to structure their own money, to make sure that they are using the structure of financing by having the debt given by themselves today, which can be offloaded tomorrow to some other banks or to some other investor who will be interested in holding the bond securities. But presently, it is all the equity money which have flown for any M&A during the COVID time.
Right, sir. Thank you so much. Thank you.
Yeah, thank you, sir. Thank you. I would like to request Vishwas to please unmute yourself and please ask your question, Vishwas. Vishwas, you please unmute yourself and please switch on your video.
Am I audible?
Yes, Vishwas, you are audible.
Very good afternoon, sir. Myself, Vishwas, I'm a fourth year learner. So my question is, what are the aspects involved in preliminary study of valuation in the case of mergers and acquisition?
Yes, of course. See, the valuation is, as I think I spoke last time as well, valuation is no more science. Remember the phrase I said, it's a piece of art these days. It's not, you cannot justify valuation of some of these companies. I think we did speak about it last time as well. Is that if you look at the valuation of maybe Tesla, it has gone from 400 billion to 600 billion dollars. Or now the valuation of this the new company which got listed in USA, which is opening at 200 billion dollars. Or some of these companies which are I was speaking about Airbnb, which is valued at 200 billion dollars, which is 4 times the size of the biggest hotel chain in the world. The biggest hotel chain in the world is valued at 60 billion dollars, and how can you value Airbnb, which is yet to come to any level in competition to these companies, is valued at 200 billion dollars? These valuations are the result of, if you just do a bit of a study, you'll figure out, is the result of excessive amount of money with HNIs and with large families in USA. Because their wealth has grown, therefore their capacity and their interest in these newish company has multifolded grown. And therefore the valuation of some of these companies, in my view, are reflecting something that should happen too late in future. So may not necessarily be what the real value of that company could be. And then we have examples here. I mean, we can't really forget the examples in front of us. Is that a company called WeWorks? which was supposed to be listed at $15 billion, today is not even valued at $5 billion because it could not get listing there. And obviously the company is not even worth, in my view, maybe $2-3 billion, not even that, because the competitive companies in the competitive positions are far more stable with far better asset based. And these companies are futuristic valuation based, where I think the valuations are extremely hyped, very, very hyped here. And this truly reminds me of maybe Raman they will know is there I think we spoke about it last time, is there .com bust time. There was a time when every company which was just adding .com to their name was valued 10 times of their existing value. So this is what's happening today when any company is getting into this e-commerce or e-commerce ecosystems, sort of a business of agglomeration or consolidation, of maybe Airbnb of space or Ola or Uber. They are valued enormously, whereas their profits or their turnover can never justify those valuations. I mean, if somebody values, let's say, Walmart, I understand, because it has a 500 or $600 billion turnover, Well, when you want to value a company which is a $3 billion, $4 billion turnover with a $100 billion valuation, you wonder what's going on. I mean, valuing Walmart or valuing Apple because of their extreme profits or extreme turnover is something which is understandable. But valuing some of these, newish companies when they lack both is, is just beyond a reasonable imagination.
Sir, I have a follow-up question. Can I please ask?
Yeah.
Okay. So, sir, what do you think are the options left with the future group where they are they're tussling between Reliance Industries and Amazon, and also what will be the effect on this tussle on their valuation?
No, I
As
think I mentioned last time that because I'm the lawyer for Amazon in the deal here, I will not comment anything on that point. Thank you.
Thank you, sir.
Thank you, sir. Thank you. Thank you, Vishwas. Now, I would like to request Subhansh Thakur to please unmute yourself and switch on your video, and you may please ask your question. And after asking your question, you please switch off your video and please mute yourself. Subhansh.
Yes. A very good morning, sir. Thank you for this wonderful session. Then I will proceed with my question is, in the recent time, we have seen that the government is taking some active measures to boost the corporate bond market. In pursuance to this, the government has also passed the Bilateral Netting of Qualified Financial Contracts Act 2020. The government is stating that through this, it wants to develop a active corporate default swap market. So my question to you is, will this developed CDS market impact the mergers and acquisitions landscape in India? And if yes, how? Thank you, sir.
No. As I mentioned to you that for any business, any M&A, one of the most important ingredient, it is not the most important, it is one of the most important, is the financing, is the money. And any step taken by the government to this effect, where they increase the mobility of money, increase the marketability of money, will go highly favorable in favor of the M&A activities in India. I think I did touched upon last time is that investment has an income multiplier. So for all those who are economic students, you will understand that every rupee invested in the economy yields into 5 rupees or 10 rupees of the income generation in the economy because of the multiplier effect. Because every rupee invested translates into generation of more employment, that translates into more consumption, that translates into more money in the hands of the government as well as the producers end of the day, and the circle generates more money by investing the same rupee here. And obviously, so this is multiplier effect is there on anything done by the government where they promote these bond markets or these I still call them matured lending markets. It will, I mean, because traditionally The banks were the lenders, and as now I think things have improved a lot. But let's say 6-7 years ago, all of our nationalized banks and all big banks were going through the most stressful time of their banking, the corporate life. Now they are far better positioned because of the IBC, the Insolvency and Bankruptcy Code, where there are more than 2.5 lakh crore rupee of the NPAs are settled or are paid off, where the money has gone back to the banking system from these non-performing assets because of the resolution of those insolvent companies, and another similar amount is expected in just 1 to 2 years. It may have been done had it not been the COVID time. It may have been done by now because some of the very large bankruptcies are still on hold. Otherwise, you'll find that the banking system will be again well positioned to do the lending. But because the economy is growing at this rate here, because we're expecting ourselves to be a $5 trillion economy, because it means more investment, it means more, it means more need for financing, it means more avenues of financing, and therefore any step taken by the government in this regard will always have a very positive effect on the M&A activity.
Thank you very much. Thank you.
Thank you, sir. Thank you very much. Now I would like to request Devanshi to please unmute yourself and switch on your video. And you may ask your question, Devanshi.
Good morning, sir.
So,
So first of all, I'm Devanshi Rungta and I'm a fourth year learner. So firstly, I would like to thank you for such an informative session and the new ways of financing that you discussed with us. It was quite informative. Sir, my question pertains to the bonds, the ways of financing that we discussed and the bonds part of it. So, sir, leveraged buyouts, when we talk about leveraged buyouts, I would like to know why the scope of leveraged buyouts has decreased in India. Like, from 2008 to around 2014, we saw a rise in the transactions through leverage buyouts, but now it has been on a decline in specifically in India. So why is that?
thank you very much. The see the I think I've mentioned that the biggest problem or the biggest issue is that Indian regulations do not permit lending to buy shares. Now, for a very good reason, I'm sure. The good reason is that they do not want the lending to be happen for the speculative purposes. Because if the lending happens on speculative purposes, it means it's not getting truly into the right businesses, and therefore it can be the default risk could be higher, and that can affect the money of the depositors who may have deposited money in the banks. To protect that interest of the public at large, the financing of the buying of shares by traditional lenders in our country, which are the banks and NBFCs, was restricted, and therefore we never had the leveraged buyouts that happened in the past. But with the foreign funding coming in, including the FPI debt or the bond markets, the leveraged buyouts are coming back on track here. But as what happened in the market itself, if you just look around, the buyouts are happening of those or happenings more in those sectors where the equity money is chasing the targets. So it's all about e-commerce or the e-commerce ecosystem, starting from maybe our biggest e-commerce company that we had in India called Flipkart, like an Indian setup company, or anybody, anything else, could be your Ola or your Oyo Room. So pick up any example where the highest amount of money was contributed. This money was contributed not through a leveraged buyouts. This money was contributed through the equity investments of the large investors all over the world, including SoftBank or some of these Middle Eastern or some Chinese investors. They made investments there where they did not take any loans to make investments, and that also was one of the reasons where the traditional leveraged buyouts did not happen in India. But Will they come back? One doesn't know as of now, because there is still hot money chasing these sectors till now. So this thing has not gone down as of now. Even if we feel that, or some of us feel that the valuations could be hyped, but may not really be. I mean, it could be our view that they are hyped, but then there is a massive view going on in the world that these valuations represent the futuristic valuations and they will hold good one day. So for so long as this whole tussle remains, you will find that the hot money is chasing these sectors where no lender will put money. Why is lender not lending money to these e-commerce companies? Is because the two most important reasons, very, very important reasons. One is that majority of these companies are incurring losses. They all are incurring losses, and they all survive or thrive on the carry forward loss. If I'm a lender, if you are a lender, will you lend money to a company which is incurring losses today, and in their business plan for next 10 years they don't have any plan to make money? They only have plan to gain market share. They have plan to increase their GMAs. They have plan to do left, do right, but not to make profits. So as a lender, you feel that who will service my loan if I give loan to this company here? And therefore there is no loan that comes into these companies which are not making that profit here. First part of it. Second part of it, if you remember, I spoke about secured unsecured lending, and the most preference way of lending usually is a secured lending. And usually these companies have nothing of their own which they can create a mortgage on, or create a charge on, or create a security on in favor of the lenders. And therefore lending still eludes these companies in a larger sense. They may still have taken some working capital financing from the banks, which could be a fraction of their overall financing happened in these companies in equity. But yes, in terms of a large, in terms of a quantum sense or a large sense, these companies have not yet taken the recourse, or have not yet got the lending coming to them. So there are no loans given to these companies, where you see in the highest amount of M&A activity in India and all over the world, for the obvious reasons that I mentioned here. And therefore, in a sense, in the graph, the leverage buyout is going down, because these are the sectors which are growing, and where the lending is not coming. Another sector I can tell you, if I just speak about FDI in India, two sectors have received highest amount of money in last 6-7 years. Two sectors clearly. One is, of course, these e-commerce and this ecosystem, which has received big amount of money. Second is the real estate sector, where the money has come only in the fully built up leased assets. Money has not come into the development of the projects here, or construction of the projects. Money has been inflowed in India in fully built up leased assets. There again, the money came through the capital to buy out the assets. Money did not come as a debt to these assets, because the debt capacity was not there in these assets. It was all about how much can you invest, and you keep earning some periodic returns back to yourself, because the investors in this sector were largely those pension funds of European markets or Canadian markets, or maybe US as well, where they were just looking for some steady return of 2-3% on a dollar term for their investors into this sector. And therefore, or maybe money also came in a bit into infrastructure and telecom as well. But those two sectors have taken large amount of loans. But these two sectors, I mean, the e-commerce and its ecosystem, and that we call it a core real estate sector, they have not seen that large loans being availed or being given to them in that sense, and therefore the leverage buyout has actually, with financing, has gone down.
Thank you so much, sir. It was really helpful.
Thank you, sir. Thank you very much for pondering over the issues of finance in M&A. Thank you very much, sir. Now I would like to request Devansh Shukla to please unmute yourself and please switch on your video, Devansh, to ask your question.
Good afternoon, sir. Sir, am I audible?
Yes, you are.
Yeah, good afternoon, sir. Thank you for the enriching session. I just wanted to ask, if we consider the factors like EPS or MPS, how do you think that M&A financing affects the performance of a firm with respect to these factors? Thank you.
You see, especially in M&A, the financing will have to be sustainable. Sustainable means that the earning capacity of the target should be able to service the loan and should be able to pay back the loan. So as I just spoke about some of these e-commerce or these companies where they have been incurring losses until now in their business model for next 10 years also, they'll be keep incurring losses. It means that their earning capacities is such that they will not be able to sustain the loans or pay back the loans, and therefore the loans do not come into these sectors here. But if you take loan into any company which has some earning capacities and some profits, then the moment you have interest obligations coming in those companies, it may change the dynamic of the company itself. So if let's say a company requires more debt or more equity, it has to be on the basis of the earning capacity of the company in the business model, in the performance of the company. The moment you have one thing given over the other thing, the moment you have more debt than what the company can sustain, you will find that there will be a mismatch in the cash flows of the company very soon, and therefore the company may really become insolvent very soon. So, as an example, the loan to equity ratio has to work only in that sort of a number where the company from its profits can sustain or profits or consistent cash flows can sustain the loan. If you have taken more loan than the company can sustain, in the, let's say, in the within the right time frame of the term of the loan, then the company will become insolvent very soon. Therefore there has to be more equity and the right amount of loan. And therefore, just imagine that if you have taken more loan, your EPS in the company will obviously go down because you service interest. Your earning per share will immediately go down because you got a factor of high interest component. So it has to work in a very balanced sort of analyzed model.
Indeed, sir. Thank you. Thank you, sir.
Thank you, sir. Thank you very much. Now I would like to request Amit Kumar Saha to please unmute yourself and please switch on your video, Amit, and ask your question.
Hi, sir. My name is Amit Saha, and I have two questions, sir, here. Uh, First is, what is the legal backup and implication of crowdfunding and peer-to-peer funding in India? And my second question is, sir, how important is it to privatize public sector bank, seeing that the 90% business in India is doing by MSME sector from tier 2 and tier 3 cities, and there the presence of private sector banks is very less. Thank you, sir.
I don't think it's this 90% may be the right number. Of course, there are large. See, this percentages, again, you need to understand two things: the quantum of the money versus the quantum of the borrowers. I think you may be right in terms of the quantum of the borrowers. It could be your MSME sector, which could be very large in numbers. Then the quantum of the money, where the large amount of money goes into the large sectors or the big companies in the country here. So obviously, it is not just the banks which are giving loans to the MSME sector. So things that I did not touch upon today is that guarantee companies. So there are these guarantee companies or the government's new regulations for giving guarantees to the loans of MSME sector is now the new buzzword that's happening here. So we have been working with some large foreign, uh, we call them impact sector financing companies. Again, there are, as I told you, this financing itself could be a area where we can spend hours and hours. So another new um, the financing sector that we are now working these days is called impact sector financing companies, where there are these large corporates world over where they have dedicated some funds to support the MSME sector in India in a way where they are themselves not giving loans to these sectors, but they are giving guarantees for their loans to the uh, to the NBFCs or to the banks giving loans to these or the companies in these sectors here. So if you look at these MSMEs from micro to small to medium, they are not just banking on the bank loans. They are also getting loan from the non-banking company as well, which are the microfinance companies, where microfinance companies are getting the backing from these guarantee companies, where their loan is guaranteed by the guarantee companies. Now, why the guarantee companies are guaranteeing the loans of these MSME sector? Because they are getting a guarantee fee and they are also evaluating a risk attached to the portfolio on a portfolio basis of all the MSME sector here. So there is still enough action happening right now. Obviously, a lot more to be done in the rural financing, which is still handled by traditional banks or the cooperative banks. So don't forget the cooperative banks, which is another means of finance for the rural or some part of the micro business working in the semi-urban areas, which are again big um, source of capital or financing for these companies here. I think this part as well will see some more maturity in time to come with the government regulations, where the government itself announced guaranteeing the loans of MSMEs, and with some companies entering into the sector where they are giving guarantees for the loans availed by this micro and small and medium companies here.
Sir, my first question was what are the legal backup and implication of crowdfunding and peer-to-peer funding in India?
Even that is, yeah, that even that is maturing. It's still at a very nascent stage. It is maturing right now. So one is that how do you see? You just remember, um, in India we do not have the regulations for these, let's say, financing models in that sense. Then how do you implement these financings from a legal perspective? Is that these means are to find the end, let's say, the borrower or the lender, and the lending happens through the written lending contracts. But these segments are yet to mature more in India.
All right, sir. Thank you very much.
Thank you, sir. Thank you. Now I would like to request Abhijit Chaudhary to please unmute yourself and switch on your video. And you may please ask your question, Abhijit.
Am I audible? Hello.
Yes, Abhijit, you are audible.
Good morning, sir. So my name is Abhijit Chaudhary. I'm studying in third year, pursuing BBLB from Symbiosis Law School, Noida. So my question is that how does any merger or acquisition activity impact the share market, or how does the share market respond with respect to any information about a merger or acquisition?
Hi, Abhijit. It's a bit of a generic question. I
Yes,
mean, every M&A cannot impact the share market, or every share market movement cannot impact every M&A, in the country. It's just like that. It is that specific M&A of that companies can affect its shares in the market here. So, as an example, if a company which is listed, let's say Reliance, which is listed, if Reliance is, getting new FDI from in their subsidiary Geo platform from all these investors, obviously it has reflected in the valuation of the shares of RAL at the stock market, which had increased tremendously because the real value was getting discovered by the valuations given to its platform, which is a wholly owned subsidiary by these third-party investors. It has to correlate from a company to company for its share versus its M&A to be directly or proportionately linked.
all right, sir. Thank you so much, sir.
Thank you.
Thank you, sir. Thank you very much. Now I would like to request Anmol Mathur to please unmute yourself, and Anmol, you please switch on your video and ask your question, Anmol.
Good afternoon, sir. My name is Anmol Mathur and I'm a fourth year learner. My question is pertaining to the valuation and the consideration in case of M&A transactions, and it is how has COVID-19 impacted the pricing methods and the deferred payment system in the M&A transactions?
Yeah, COVID has impacted the valuations anyway because I think it's just imagine that what happened in COVID is the market shrunks. Why market shrunk? Let's say people who are locked down in their houses or who have limitations on their movement will not go to cinema halls, will not go to malls to buy new clothes, will not do enough shopping of the luxury goods here, will not buy new cars, will not buy new motorcycles. I mean, people will not cross tolls to pay the toll roads, will not fly, therefore no money to the airport and the airlines. So this had a cascading effect. Obviously, then all these sectors or all these companies are getting affected by COVID directly. But then there were some gainers as well. The gainers were all the I think we spoke about it last time. The gainers were all the your e-commerce companies or your e-education companies, your healthcare companies, telecom companies, your digital media companies. They gained hugely, significantly during this time here.
Yes, sir. So,
Which were getting affected were all your other businesses, your hotels, airlines, your automobile.
So a little follow-up question: how has deferred payments in this situation, particular to COVID-19, have the system of deferred payments been looked down upon as a problem because of the current scenario?
No, cannot be. In my view, cannot be because don't forget here that RBI itself granted moratorium for first 3 months from all payments. It means that they had deferred the need for every borrower in the country to make payment during that time. So deferment was must during this time here, and not just RBI regulated. In my experience, almost all lenders in the country, including all foreign portfolio investors, they had rescheduled their loans with their borrowers by deferring the requirements to make any capital payments towards the return of loan or interest servicing during this time, because some companies I mean, because of the lockdown of 3 months, some companies have a far bigger cascading effect of catching up on the business for next 12 months or so. So just because we can't say that just because the country was shut for 3 months, the airlines should come back on its feet after 3 months. It cannot happen like that. The cost of non-operation and the cost of still paying all the everything that they have to pay, including their airport charges and refund to all the customers, is so high that they can either go bankrupt or it will take them longer time to come back on their feet. And therefore the need for deferment was not just these 3 months lockdown, but getting the full impact of how you can come back in action. And obviously economy is seeing as we have been reading in the newspaper and seeing around, economy is seeing a very v-shaped recovery, but it'll take time for some sectors which actually has borne the burnt of this COVID. But having
Thank you
said
very
that,
much, sir.
I must still highlight there was a blockbuster IPO that happened of Burger King last week. I don't know how many of you seen here. Despite of there being lockdown, you still have some of these food companies making tons of profits. I mean, the Burger King IPO was second highest listing in terms of the listing price in the country, second or third highest listing price it had seen, and it again, just going up. And before that, we had the Happiest Mind, which is an IT company, IT support company, set up by Mr. Suta. Seen again blockbuster listing here, and we have another IPO going on today. So I think the market is still showing some very good recovery results for some sector, like these food companies or IT companies, which are into this, which are the big gainers during this time here, and obviously some are suffering heavily.
Absolutely, sir. Thank you, sir. Thank you very much for this. You can say like all these kind of latest information as well. I would like to request Stuti to please unmute yourself and please switch on your video, Stuti, and you may please ask your question.
Hello, sir. Hello.
Yes, yes.
Yes, Stuti, you are audible, Stuti.
Yeah. So, good morning, sir. I'm Stuti, a fourth year. Good afternoon, sir. I'm Stuti, a fourth year learner. So, my question was, what key risks should finance executives consider in the planning of the M&A?
What is it?
So she was asking like what are the key considerations a finance executive basically should take in consideration regarding a merger and an acquisition.
Sorry, can you say it again? Rajnish, I can't follow.
Definitely, sir. Definitely. Actually, there was some technical issue at the end of Ms. Stuti, so I just want to like rephrase her question. She just want to ask what are the key considerations which a finance executive should take in case of any M&A activity.
Yeah, I think the consideration is, what we spoke about. This can be like a one sentence reply to the whole session that we had. It is all about, the it says. So I think we'll take this as the last question, and I'll just say financing. End of the day is it's between the borrower and the lender. If I am the lender, I'll tell you what I need. If you're the borrower, you can tell me what you can offer. And then we both have to agree and negotiate and get a sort of a middle path as to where I can and how I can lend you the money, at what rate, against what security, against what listing, against what collateral. And once we mutually agree to this sort of arrangement here, we'll have a financing transaction getting closed. And if I just take a step back, when we spoke about these large M&A or any M&A deal here, a financial closure is must to have a successful implementation of a venture. If I do not have a financial closure, it means that if I do not have the adequate financing in place for my business to start running, my joint venture will not be successful. So as an example, if I'm having a joint venture to set up a automobile factory in India, and for that automobile factory I need let's say 100 crore rupee of loan. Until that loan is tied in, I have the sanctions from the banks given to me. Until the loan is available with me, this joint venture also will not make sense, because my equity was not enough or never enough to have the successful implementation of my venture. I can still have a joint venture, but for this business to be up and running and to be, seeing the profits to see the day of light, I need to get the financing in place. And the financing is between, it's a two-way process. It's between the person who's giving and the person who's taking. So, we touched upon various means, various, financings which are going on in the country here. We touched upon the traditional securities. I mean, obviously, maybe sometimes in future, I'll still would love and talk more about the crowdfunding and the peer-to-peer funding or these micro lending which is going on in the market, or the impact sector lending, or some more detailing of a sector specific lending that happens here because of the necessary structures that need to put in place, or the buy and sell of the loan portfolios, which is now happening in the country here, which happens very frequently, in offshore jurisdictions, where you just simply buy 10, 20, 30, 40 loan portfolios, put them into a different sort of a structure and issue the securities and keep, having the securities traded, where liquidity is generated. Liquidity is must for the sustaining of the company's future here, and the investor is getting some return on the investments made in those, credit default swaps or some other sort of a, bond that can be issued on those structures here. And again, these are interwoven heavily with the M&A practice. When we spoke at first, the introduction that we had in place in our mind is that we just speak about the practice area for corporate practice, which we spoke about the key corporate transactions where we, negotiate, finalize, write, draft those agreements for joint ventures, for the equity investments, or for the business transfers, or which are contours of these, investments part of it. Which is second wing, which we spoke about, is the financing part of it. There again, we write the bond issuance agreements. We write the all documents for the securitization of these bonds or the debentures. As part of any legal practice for any corporate M&A lawyer, we also assist for listing of these bonds, at the stock market. We here means that not mean person, means a corporate lawyer who's practicing this, who's practicing corporate M&A practice, is part of its role is also to work on these financing or very actively into these financing transactions as well. I think in the third round, we'll pick up the very, again, in my view, important part of the M&A transactions, which is the business transactions. Because whenever you do any such joint venture or you do investment here, you always have supplemental of business done in that sense, where one of the joint venture partner contributes or avails something which is to do with the business of the joint venture. I think I'll touch upon that in the next round when we speak on that, and then I'll quickly touch upon how these three things are so interwoven that when we do one M&A, we do all these things every time when we do a deal here, or almost every time. So when we speak about M&A, we just don't do the lawyers or the M&A lawyers, they just don't do the one JV agreement or the investment agreement or a shareholders agreement as part of the composite sort of a transaction. The practice also entails advising on the NCD issuance these days, bond issuance, taking loans and financing for the financing of the ventures, financing of the share acquisitions, financing of the corporate acquisitions, or when you're making a bid to buy the same company from insolvency courts here, then getting the finances in place to buy it out. And then once the company is bought, at the time of buying of company, buying of these ventures, the underlying business arrangements, it's all about a business. The underlying business arrangements with the respective parties or their affiliates will have to be in place for the business to just be in existence and start running. So I think when I do the third component last time, the next round, then of course we'll touch upon how they are so nicely very integrated to each other.
Thank you very much, sir. Thank you very much for taking up all these questions and you can say, I just want to say that's why this class is being called as master class, and that's why you are called as a master of this subject. And I really, sir, because I am also from this field, and I really like, after listening you and after mentioning all these points in just, you can say, in only 1 hour, it can be done only by a master only. So I'm really thankful to you, and on the behalf of all participants, I should say only one thing. Thank you very much for imparting such a knowledge to all the participants. Thank you, sir. Over to you, Director, sir.
Thank you very much, Mr. Hardeep and Mr. Rajneesh for the words. But as everybody, well, there were references made, and I could see that, the points which are covered in session 1 by sir, and then session 2, I could see that there were certain questions so referred respect to what was covered in session 1. So I would request the participating audience as well that please keep that in mind before you raise the question. This is a humble suggestion from mine. There was a reference made in the context of mergers and acquisitions that when we talk about the said to be the 01, said to be the, rather people said our shift to knowledge economy, and wherein the binary numbers became most important, and first word which was so famous, that was Hotmail, and that whole thing of controlling Hotmail, then buying it, and then Indian becoming so famous. And Mr. Hardeep made constant references to that. And later on, everybody knows that what value Hotmail had once that acquisition was done, and where did it go. So was the case with Yahoo, then Netscape. You all will find those responses therein. And if you have paid attention, last week has been rather, I would say, very volatile when it comes to the companies. Especially there is an action by the Justice Department in United States of America, wherein there is an attempt that they are trying to avoid the intertwining, which is earlier was agreed by Facebook that they never will do with respect to Instagram and WhatsApp, and they ended up doing it, and then that action has started. And second, in the European Union, there is one more legislation which is coming, and Google has already taken objection to that. So what these two may have that largest impact on these decision makings as well. So we also need to see this, and next time, as sir would be, as he already has cleared what he will be covering. So one may make reference to that, and please come read on that and how it will also impact, because it does have its own impact in India. Because last lecture, sir made reference to data is the new currency. Rather, it is something which will remain forever. So please understand that aspect as well and how it is so. So technology transfer was one, but now when it comes to the data, so how it is used. So data, we are not talking about what you use to run the internet. We are talking about what one achieves it. So one has to focus more about the intangible assets, incorporeal possessions, and how it can be the part of mergers and acquisitions, and what value it will bring. And that was valuation. Many people were asking questions about valuation. So please focus on that property aspects, the tangible, intangible, corporeal, incorporeal, that you have studied in jurisprudence as well. So as again, sir, thank you very much for the session. And we look forward to your session number 3, which is scheduled on December 23, 2020. And I would request the August gathering that please attend that session and please enjoy it and make it more fruitful by coming and asking questions related, so that we also will learn from you. So thank you very much, everyone. And thank you very much, Hardeep sir. Thank you very much, Rajat sir, for moderating this.